Hey there, folks. This is Mitch Firestone with Precision Trading Labs, and I wanted to share with you quickly some setups that we just put together and are looking to hopefully execute at the end of this week or hopefully next week. Um, what you're looking at right here is a chart of relative strength of the various major sectors that make up the market. So, we've got the industrials and utilities and the financials and energy and health and real estate and all that stuff. So, at any rate, actually been in a choppy to a downward market over the last 2 or 3 weeks or so. But the one major source of relative strength that we have observed is energy. As you can see here, all of these other sectors are either barely up 1 or 2% or actually down as much as 7% with energy, with retail. But yet energy is by far the big star, up almost now at 20%. So, in fact, the way we look at the markets, we're going to be looking to capitalize on that by looking at and finding some setups that are based on that. And what we're going to be doing is looking for pullbacks in some of the stocks in the energy sector in order to then go long. And the way we'll go along is either by buying the stock or by taking some sort of bullish options position. And of course, the most simple way to do that is to buy calls. So let me show you a couple of setups that we're now looking at here. So here we'll start out here. First of all, this is the energy sector itself. This is the ETF, the XLE for the energy sector itself. So in fact, if we get a minor pullback to this region here, this would be a good region to go along. And what we're doing is we're looking at this is what we refer to as a demand zone. So what happens is price rallied into here, consolidated right there in that little red candle there, and then rocketed out of there with that very bullish green candle. Right here was an exhaustion of sellers, and so basically what we're looking for is a return to this region where we expect that the buying will resume here and we should see a bounce. So we can either express that by buying stock or again by doing this via buying a call. So either, of course, being a bullish position. So there's two different ways of expressing the trade. So again, we're looking for a pullback to this region. We would get in at 61.47. If for some reason the trade failed, we would bail out at 60.20. That's where our stop out point is. Okay, so we're always managing risk, of course. So anyway, that's one of our setups here. Here's another one, NOV. If you notice, that looks very much like the XLE chart. Again, price rallies up. This is an area of consolidation where it based. Again, it rocketed out of there. And again, if we get a pullback to 1508, that's where we would buy. And again, our stop out point is here at 1445. Okay, so that's another setup there. Another one that we're looking at here is KMI, Kinder Morgan. Again, price came up. Notice the right price here based over here and then came out here. So where again, this is an area where there was some consolidation. We then got a bullish move out of there, and we're looking for when price returns to this area, we're going to basically buy over here, and that's where our stop out point is. When we were looking at this on these other two charts, you'll notice that these were both daily charts. So these are, each bar, of course, represents 1 day of price action. On this Kinder Morgan chart, this is a 1 hour chart, so we're actually looking in a lower time frame. So this would be a quicker reacting trade generally from this lower time frame setup. And then the last setup that we have waiting here is APA Corporation, used to be referred to as Apache. It's another member of the energy sector, of course. Right here again, we had price came over here, was over here. Right here, it dropped down, based, and then notice that it rockets out of there with a great deal of energy right here. So we're waiting for a pullback here, and we basically laid out an options trade here. So if we get a pullback to this region here, we'll buy at 29.17. Again, our stop out point will be about 60 cents below. And what we'll do is we'll express this by buying an option. So we're going to buy the July 15th July 15th expiration, the 27.50 strike price. So we'll be buying this approximately what is that, about $1.60 in the money. So we'll be running a delta of probably about 60 or something like that. So for every dollar that Apache moves, the option should appreciate by 60 cents or so. So that's going to be our option setup here. So we'll buy the July 15th, 2750, and looking at the platform, that option, if we get the pullback to this region, the option should be valued at approximately $5, which means of course that the contract, since it controls 100 shares, will cost us about $500 in buying power. So those are the setups. So again, we got the Apache or the APA waiting for us there. All of these we're basically waiting for a pullback here, and then the other ones, of course, Kinder Morgan, and we got the XLE ETF itself, and a couple of other ones. So at any rate, that's what I got here. So hope you found this helpful and interesting, and I will see you guys soon. Thanks.